So enough of that. Let's get into the report. What's going on in the multifamily industry?
yeah.
There's a lot of macro stuff going on, but let's try to filter the noise and get into what's happening. Yardi Matrix multifamily winter report 2022. Matt, are we having deja vu? Bring us in this report.
So yeah, loyal listeners and viewers of the Gray Report will forgive me for it seems like we're seeing the same thing again. But I do promise that this is a different report. The Yardi Matrix report that we talked about a couple weeks ago was part of their monthly reports, and this is a seasonal report that is more in line with the reports that we've read from Marcus and Millichap and CoStar that take these broader scale issues in the economy, capital markets, and the multifamily market itself. January is almost over, and this may be the last one of these that we will encounter. Unless it's really spectacular, I'm not going to try the patience of
something
anyone
that's
or
different
myself.
that stands out. And
Yeah. Aside from that, though, there is plenty of good stuff in this report, and one of which is this chart that you see about rent growth that we have here, that you can see the real flat line from around August through the end of December, and it illustrates that this breakneck rent growth that we saw in 2021 may really be cooling off. It's still growing, but it is cooling off. And I've been thinking about this. Part of what I was thinking about when I was gathering these sources was the idea of momentum. And a lot of times you see momentum used as like building up steam.
Yeah.
Momentum is more like this chart. It is it's what happens after the steam gets built up. It is the energy that's kind of carried forward. And I think that 2022 is going to be a year of momentum, not necessarily rent cooling, but it will be a slower growth that was carried forward from 2021.
Well, that makes sense. And we've been talking about this. Again, it's more returning to normal, in a sense. And I think it would be more dangerous for the long term if we saw unbelievable double-digit growth 2 years in a row. That would be very disruptive.
And that's kind of the market-defining question, is if on the rent growth side, there's momentum and kind of a slowing scale, but then energy is still building up when it comes to the asset prices themselves, maybe compressing cap rates, or they're flooding in from, the volatile crypto and stock markets. And then really we get these, they are the ones that are building up steam. So that's just something that I'm keeping my eye on. And then we'll talk about that later.
But there's a lot. Wages really start picking up too. And just all the other inflationary pressures.
And that's another thing too, is I wonder, especially when it comes to housing affordability, and we're going to cover this in a little bit, what the hard stop is when it comes to rent growth, because it really can't go on
there's
forever.
been ceiling, typical, wages, but those wages keep increasing. That ceiling continues to rise as well. Matt, I'm curious, how much of this, because there's certainly a degree, but starting in August is a little early, how much of this is seasonal? Because we
that's a really good point.
always see a leveling off. In August, September, people are back at schools. They're just, people aren't moving around as much. Things are getting a little bit cooler. Eventually, and we see this in the occupancy rate also. That is kind of flatlining, or at least leveling off in that August period. And again, I'm just wondering if it's more not necessarily. Again, they're not really reporting declines, but it's really just a slowing down. And is that just there's just less activity, and just typically, we just not raising rents as much if we're not getting as many people walking through the door. So that I am suspecting that that's certainly at play, but I'm just wondering how much. But one other thing, Matt, though, that I find this interesting in is how this is coalescing between lifestyle, overall, renters by necessity. Think of renters by necessity as workforce housing.
Now, for listeners, you see there's big gaps between the essentially the A, B, and C class, or the lifestyle renters and the kind of workforce housing. And there's a huge gap that if you're looking at like November of 2017, and they have just pinched, it's like someone took these line graphs and pinched them all together, and now they're almost like uniform.
The lifestyle, the A-class assets assets had, historically, this chart goes back to 2015, been slightly lower than the renters by necessity, that grew even more in 2020 when I think a lot of people weren't moving in. People were kind of staying put. We saw that, but then it just started, those units started getting leased up, and now they're almost at parity, averaging over 96% nationally. One good thing to note, though, Matt, is it's fun to look at all these reports, the national reports. Yeah.
So I did.
Sometimes though, and actually really often, they're only so useful. It's good to understand just the general sentiment on the housing market, and but every market is so different.
Oh yeah.
Every state, every city, every county, and then every single submarket. We see vastly different growth just within one city itself. The suburbs are performing completely different. The urban core. This is really the general momentum is a factor.